Hello friends. Last week in my video, I talked about the bulls requiring to buy bigger lots and bigger chunks of shares if they were keen on pushing the markets higher. Well, risk appetite was definitely there, but clear-cut conviction to buy big chunks was still missing. What's keeping the bulls spooked and at a distance? Why are they unconvinced? What's making them nervous? This video will contain a special segment at the end to discuss all those aspects. So let's dive right in, and on your screen right now is the market roundup window, which tells you that the mild rally, was led by the broader based Nifty, and the banking index, the bank Nifty, brought up the rear. The US dollar index, the Dixie, continued its fall, and which is what is propping up the emerging market indices, including India. Commodities rose, especially silver, which appears to be stronger than gold, and natural gas rose, but crude oil fell. This is in line with my article in Money Control and my free Telegram channel post that there is no super cycle in commodities, in my humble opinion, which I have been advocating since early 2022. So the USD INR, which is the dollar versus the rupee, rose a tad in spite of the fact that the Dixie fell a little. So the dollar is showing some relative strength versus the rupee. The Indian 10-year benchmark bond yield rose 7.03. Rose to 7.03%, which means bond prices fell, which is what is making the bank Nifty a little lethargic. The NSE continued to log gains in market capitalization, which tells you that the rally was broader based. The MWPL continued to rise along routine lines, and overseas markets, barring the Nasdaq, which impacts the technology stocks, provided tailwinds to domestic markets. Coming now to the market-wide position limits, or MWPL, which tells us what is the percentage exposure utilized by traders as compared to the total exposure allowed by SEBI. Well, what we are seeing is that the lows and the highs of MWPL are progressively rising since the last two derivative cycles, which means big money is writing out bigger checks to take exposure in the market. So it's not that risk appetite is not present, but it's not present in large enough numbers. We need the MWPL to rise well past the 35-36% mark to be able to make a big difference to the markets. Coming now to the stock and indices futures turnover. Remember, this is cumulative of all three derivative cycles, that is June, July, and August. What we saw was that the turnover fell a little. This is not exactly good news in a week that saw gains. That means trader participation, especially one Marshmallow traders. The Marshmallow theory is explained in the description and the pinned comment below this video. So one Marshmallow traders were basically showing lower buying conviction out here. Coming now to the NSE advanced decline ratio, which is a leading indicator only after the price. So it is one of the fastest indicators around. What you are seeing is the advanced decline ratio has also eased marginally to 1.15, which means for every 100 stocks falling, there were 115 stocks rising. That's lower than last week, which was at 1.29. So one Marshmallow traders here as well are showing smaller risk appetite. I'm now coming to the NSE Nifty and Bank Nifty futures basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot, and is also a measure of the risk appetite. Basis for both indices fell. Now, part of the reason is as the derivative cycle moves on and expiry appears closer, the basis contracts, just like options premium contracts closer to expiry. But it also contracts due to unwinding of long positions and or short selling at higher levels. So the fact that the basis is fallen, it tells me that there was selling at higher levels. I now come to our exclusive in-house indicator, the impetus, which you've learned to rely upon for 2 years now. What you are seeing is that the impetus reading for both the indices has fallen. Coming on the back of the fact that both the indices have risen, although the gains admittedly have been very small, the indices gaining and impetus falling tells me that the rally lacked momentum. It was a half-hearted rally. This indicator you will not get anywhere in the public domain on the internet. So both the indices are showing impetus readings at the lowest level, almost the lowest level in the 20-week period. That tells me that the coming future will see prices move sharply. Volatility can be higher. It can cut both ways. So let's be careful out there. Now for another exclusive in-house indicator, the LWTD, or the Lift Weight Thrust Drag indicator. Here again, a tutorial video is in the description below this video, as well as in a pinned comment below. The NSE percentage gain of the Nifty remained tepid at 0.16% on a week-on-week basis, but it was for the second week in a row that the LWTD managed to rise and stay above the zero mark. So fresh buying support at lower levels is forthcoming. Remember, you don't get this indicator anywhere else. It is our in-house exclusive indicator. So lower levels will see buying emerging. That's not really a problem. Friends, the in-house indicators done, I now come to the bond market, where we have been leading the overall market analysts in the public domain by talking about bonds before equities since many, many years. Because this is a market that provides finance and funding for the other asset classes. What you are seeing is the 10-year benchmark bond yield has crossed upwards above 7% after being under pressure for 9 or 10 weeks in a row. That basically tells you that there was a corrective rally in the bond yields. Also remember that there is talk about interest rates having peaked or maybe even possibly reversed in the coming 1 or 2 monetary policy or MPC meets of the RBI. So bond prices are showing a bit of volatility. But here again, unless and until bond prices cross 7.20%, I would not advocate laddering in sovereign under any circumstances. Friends, the bond market's done. I now come to the Bank Nifty, which rose 0.12%. And as you can see on the daily chart on your screen, it rose on 3 out of 5 trading sessions. And the 44,152 level still acts like a last mile resistance. This is a point at which overhead supply is coming in from traders who are trapped at earlier swing highs and are basically attempting to exit from their existing long positions. The price remains above its month-long moving average, which tells me that the short-term outlook remains positive as of now, but the moving average is catching up fast with the price. Switching to the weekly chart on your screen, what you are seeing is a bullish candle in the last week of trade, but it is an inverted hammer, which tells you that the bulls attempted to pull the markets higher, but faced resistance at higher levels and surrendered ground to the bears. In the bargain, the price has closed at the lower end of the weekly range, and the candle's body is contained within the previous week's bearish candle, which means that makes it an inside formation in Western bar chart analogy. Here again, note how the 44,152 level is a last mile hurdle for the Bank Nifty. Friends, in the week before last, this index was number 7 on the most volatile counters list as per our statistical beta list that we maintain in-house. Last week also it remained at number 7, which means volatility remained unchanged. Last week, I advocated a range between 45,175 on the upside and 42,700 on the downside, which held perfectly well. In the coming week, I expect a range between 45,175 on the upside and 42,800 on the downside. The levels are mildly changed because the week-on-week movement itself was very mild. Friends, the Bank Nifty done. I now come to the Nifty 50, which rose 0.16% and rallied on 3 out of 5 trading sessions, just like the Bank Nifty before it. And the falls have basically come on Thursday and Friday last week. The 18,604 level remains elusive on a sustained closing basis, which I had talked about in my earlier videos as well as my live mint column. Price remains above the month-long moving average, which means the short-term outlook is optimistic for now. And the 18,350 level requires watching as a support in the immediate future. The weekly chart tells you exactly like the Bank Nifty, the Nifty also suffered inverted hammer, which means the bulls attempted to push the markets higher, failed, and the price has closed in the lower half of the week's range. So we are basically seeing overhead supply coming in from traders stuck at the previous swing highs of 18,604. Once this supply is absorbed, then you will see the bulls overcoming more hurdles in the future. The price remains above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook also remains positive for now. In the week before last, this index was number 10 on our most volatile counters list as per statistical beta that we maintain in-house. It slipped 16 notches to number 26. Now, do remember, it's not just the fact that Nifty's volatility has fallen. It is also the fact that the individual stock futures volatility has risen, which is why the Nifty ranking has fallen. But the Nifty was definitely lower volatile as compared to the Bank Nifty. Last week, I advocated a range between 18,950 on the upside and 18,125 on the downside, which held perfectly well. In the coming week, I anticipate a range between 18,950 on the upside and 18,175 on the downside. The statistical and chartical analysis of the indices done, I now come to the last bit of statistical analysis, wherein I give you the retail risk appetite by way of their footprint, in which segment are they trading the most, and whether their risk appetite is up or down. So what we have seen last week is that the index futures turnover contribution has flatlined and remained actually unchanged. Stock futures turnover contribution has gone up 1 basis point, which tells you that risk appetite rose a little bit. The index options turnover, which is the highest in the FNO segment, actually came down very, very sharply. From 98.63% to 98.24%. And the same magnitude of gains was seen in stock options turnover, which has gained 39 basis points. So qualitatively speaking, the bulls have shown higher risk appetite by buying more volatile instruments and instruments where the span margin requirement or premium requirement is higher than the index. So I would say, yes, the bulls are showing a greater degree of risk appetite. Now, for what I would do in the week ahead, I would wait for clarity emerging from the U.S. Federal Reserve's Open Market Committee meeting, which will be giving its projections before I start trading stocks more aggressively and proactively. So in the coming week, my focus would be, relatively speaking, higher in the commodities market. Like I mentioned so many times in the past on my Telegram channel, my social media groups, and my videos with a previous contractual assignment I had, I reiterate that there is no super cycle in the energy markets, which I mentioned in the Money Control article, giving you exact details of many oil fields and oil wells that are either coming up as new discoveries or are seeing enhanced oil recovery techniques, making the output jump significantly. So, there will be a disproportionate price movement or maybe even a complete divergence in oil and gas prices. One could rise more or less compared to the other, or even go in the opposite direction. That kind of volatility is welcome. Coming to bullion, silver looks marginally stronger than gold, and metals I advocated would experience short covering, which they did. I'm waiting for rallies in oil and gas prices to go short again, which is what I have been doing in the last couple of weeks. So, like I said, there is really no super cycle in oil prices. In spite of the Saudi output cut, look at what's happening to oil prices. Uh, Now, for the most popular segment for the statistically minded viewers who basically plan their trades on systems modules, I give you 5 stocks which gain the most amount of statistical impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks where statistical impetus fell the most, where you take big exposure, wait for small price moves. This is for scalpers. This list is valid only for Monday, Tuesday through Friday. I updated on our free Telegram channel. You may please want to connect with me there. So the impetus gainers list is led by IEX, followed by JSW Steel, then Hind Petro, TCS, and NTPC. The impetus losers list is led by City Union Bank, Balakrishna Industries, IRCTC, Shriram Finance, and GMR Infra. Friends, I promised you there would be a special segment on what is holding the bulls back. Now, last week you saw talks of recession emanating from Germany, Europe's largest economy and by far the strongest. This talk of recession has spread to the European Union, the Eurozone. And that is what is spooking the bulls, because Indian exports to that area might be impacted. Number two, you could have dollar remittances from NRIs who are staying in the European Union contracting. To that extent, inflows could be impacted. The other aspect is, if you look at the Baltic Freight Index, which is an index of not only just the freight charges paid by the international community to transport goods via sea, but also a good gauge of business activity. So the Baltic Freight Index is falling and remaining under pressure. It's currently at February 2023 levels, which is not exactly a great sign if the world economy is doing so well and economic activity was to expand. The other aspect is China is showing a great weakness in the undertone. There are reports of how the foreign investors are pulling money out of Chinese markets. So, being a big boy in the Southeast Asian emerging markets category, any weakness in Chinese markets could trickle down to other equity markets as well. The other aspect is oil prices falling in spite of output cuts by Saudis tells us that a slowdown is quite possible in the global economy, which is again another worry, which is why you're seeing the rally being a very creepy, crawly, limited, mild rally on the upsides. So bulls are showing risk appetite, but they seem to be looking over their shoulder and being a little nervous. This nervousness has to go if the market was to jump significantly higher. Friends, I hope my videos are helping you understand the markets better and trade better. Before I bid goodbye to you in this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Spread the word, share my videos with your friends and family to allow me to reach a wider audience, and subscribe to my channel. Press the bell icon to receive instant alerts about fresh videos being put up out here. I'd love to hear your comments and feedback, so keep them coming. Thank you for your patience, for being with me in this video. Till we meet again in my next. This is Vijay Bambani signing off for now. Have a very profitable week ahead. Take care. Bye-bye.